In this video, we'll be covering technical analysis, full price action. So we've already discussed what technical analysis is, but in a nutshell, it involves analyzing statistical trends using price action with supply and demand zones. The tools needed to perform technical analysis are trend lines, shapes, and other drawing tools, and an understanding of candlesticks and chart patterns. The drawing tools include trend lines, horizontal lines, channels, support and resistance zones. Alright, so here we can see price movement again represented by these arrows, and we connect the lower highs for the downward trend line, and you simply duplicate the top or simply connect the bottoms, the lower lows going down to have a channel. Now, the way to properly draw up a trend line or downward, whether upward, whether channel, flag, pendant, is to properly connect the dots. I believe illustrating on charts would be better. So heading back over to the charts here, we see that most wicks of the candles at the bottom and most wicks of the candles at the top, as much as possible, I try to touch it. So I'm not trying to have the market fit anything that I draw up. I am mostly connecting the dots of what the market already had existing, and I'm using that framework to make a calculation or prediction in the future. So again, the general concept is for upward trends. Let's just imagine this isn't here. For this upward trend, you connect all of the higher lows. So each low point, you draw the trend line to connect. And for a downward facing trend, you connect all of the lower highs, and we can go back throughout the chart and you'll find areas where you can draw up a trend line, and you can see bounces off of that trend line, and you'll also be able to see when the trend broke, for example. So we can even extend this a bit further, like so. Sometimes, like here for example, a candle or two might break past the trend. That doesn't mean it's invalid. You're still trying to connect most of the touches, and here, even though it broke past there, it still respected the trend line in the future moving forward, and it respected it once again, and you had a major push up. Even once, you can still use the trend line once it breaks, because once the price breaks the trend line, then you will be in for a change in direction. So if it's going up and the price breaks the trend line, then we know that the price will change direction and start moving down. And in the case of a downward trend, like here for example, actually I think I should locate another, but we can use this one. But whenever the price breaks above the downward trend, then we know then it's a change in direction, and the price will generally start to head up. All right. Now, how do we properly identify support and resistance zones? I'll see if I can have an empty chart here so that we can have a better understanding of what are the support and the resistance zones. So here on this chart, we're able to identify immediately support and resistance zones. And as I said, it's basically any area above or below the price the current price, where the price has respected or reacted in the past. So, for example, using the horizontal line option, we can mark up a resistance zone. This is a zone where when the price moved up, here, here, again, here, it was rejected. So it came up to this point, reversed, came up to this point, reversed. Even when the price broke above here, you can see it came down to the same area, not exactly the point, but it still respected that area, because you'll notice that most times when you draw up a line, the price does not respect exactly the line or the line exactly, but it respects the area around the line. So that's why it's advised to use shapes, so you can have a zone represented instead as the support or resistance instead of the line. But the line works fine as well. Now, when the price broke above it, it came back to retest that resistance zone that turned into a support. It supported the price, and then the price broke back. It had some trouble passing the resistance zone again. It played around and then dropped. We can move further into the future, and at some point the price will touch that support or resistance zone again. Even if we go back into the past, we're able to see this exact zone that we marked up all the way back in December of 2021. The price respected that exact zone, so we'll know that it's a valid point of support or resistance. So resistance means, in definition, above the price, and once the price breaks above that same area, can be considered the support because it's now below the price. So you can have, for example, right here we have support right here, and we already have this area here marked up as our resistance, but we have a lower resistance right here as well, so we can also mark that up right here. The reason why I put the line here is because it acted as a support in the past. This exact line that we just put here, it acted as a support right here and here. The price broke below, and then it started acting like as a resistance. So we have another resistance here, this resistance above here. So we know that if the price is supposed to, for example, break above and start going higher, we know that it might respect or react to this level right here in the future, because it has done so already in the past. So that's how we use or identify support and resistance zones on any chart. You can just use the history to be able to connect the dots, the lowest points for support and the highest points for resistance. You can have multiple support and resistance zones. It's not just one, just to gain accuracy. Like for example, that we can also mark here up, just to have a sense of idea where the market would be heading to if it moves from one point to another. Understanding support and resistance zones. It is important to understand how to identify support and resistance zones, because it can sometimes help us make an informed decision when it comes to our trades. For example, you wouldn't buy at a resistance zone because we know the price tends to reverse at that level. Same as how you wouldn't sell at a support zone because we know the price tends to reverse at that level. What does that mean? Basically, that is saying that for every time we're at a resistance zone, for example, right here, 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 or here, we only look for selling opportunities, because we know in the past, not so much the first two, for example, but we know in the past that the price tends to respect this area. So once it's coming up to this area, we're looking to sell and not buy. We're only looking to buy in the case of a support. Let me show you. For the case of a support, when price approaches the support and bounce off, then we confirm that this is a support area. So when price approaches the support again, we look for buying opportunities, and we buy here, we close the trade there, or we buy again here, we wait for the long run, and so on. Understanding trend lines and channels. In every trending market, whether the trend is up or down, there are buy zones and sell zones, which are divided by trend lines. Understanding these trend lines will lead to success. Generally, in a trend line, they're saying for downward trends, right? Let's pretend, all right, this is a channel, yes, but it's, like I said, represented by two downward trend lines or two upward trend lines. All right, so let's focus on the trend line. So it's saying in a downward trend, we look for selling opportunities once it bounces off of the resistance, downward resistance trend line. So every time the price bounces off here, we look for sells. It comes back up here, we look for sells. We open a sell until it reaches the bottom trend line. That is the only reason why we have the bottom trend line, so we know when to close the trade or how far we're selling to. So these trend lines can really, give us an advantage when it comes to our analysis, entering and exiting a trade. And for the upwards facing trend lines, we look for buying opportunities from bounces off of the upwards facing support trend line. Remember, support is at the bottom, resistance is at the top. So this would be the upwards facing support trend line. And what we're looking for, buying opportunities. So after we've confirmed that this is a trend by seeing a low and then a higher low, we mark up our trend with the next confirmation, the third point. We mark up our trend and we see that this is a upwards facing trend line. So we look for buying opportunities every time the price retraces to our upward support trend line. And we buy here, and the upwards facing resistance trend line is where we close the trade. This is our target. So this is the reason why we have the upward facing trend line, and we buy off of every bounce on the bottom here. So when the price moves up here and comes down, we buy, it goes back up here. When it comes down, we buy, we close up here. So that's the general idea behind the use of trend lines and how we look for selling opportunities or buying opportunities on the charts. So heading over to the charts, it wouldn't be as clean as the diagram depicted, but the general idea is connecting the bottom touches. We can see higher lows, and this is the 1 hour chart that we're doing our analysis on. This can also be done on the 15-minute chart, where you will see a little bit more price action and a little bit more shapes. You'll see a little bit more definition. Okay, so we found our upwards trend here in the 15-minute candle, and what I've done is connected the lows every time the market retraced. So we have the bottom here, the price went up, came back down to touch that line, went up, came back down, respected that line, went way up, and so on. So what it's saying is every time the price came down, like at the third touch right here, we would be able to buy, right? And having, just by holding control and dragging this there like so, we'd be able to see where we could close the trade. So we can open a buy here, close the trade there, or it could even be closed there. We open a buy here, we close the trade there, open a buy here, you close the trade there, and so on. So this is giving you a general idea of how to use an upward facing trend. And for the downward facing trend, we just connect the top. So any lower lows, let me just zoom out and see if I can identify any clear trends that we could have marked up. Alright, so we have one here where we could have connected the dots. Here was the first touch. It fell, came back up. It fell, came back up, and on the third touch we could have sold right here, and like I said, to know where we could have sold to, we simply drag it down and try to connect as much as possible dots, and we could have sold from here to here. Then when the price went back up here, we sell from here to here. And this is generally how we use the different types of trend lines, both upward facing and downward facing trend lines. We look for bounce or touches on the trend lines to know which direction the market is going to go. And we also look for the channels. We look for touches on both ends of the channels to find our exits and entries in trades. So, important note when drawing trend lines, you should always try to zoom out on the larger time frames so you can get a sense of which direction the market is going. So even if maybe you see an opportunity for a downward facing trend, the market could be going up on the larger time frame, and that might just be a retracement. So it's good to analyze the charts and see at least what's going on the larger time frame. What is the general sense of the direction? Is the price going up? Is the price going down? Has it been going up for a while? Has it been going down for a while? And so on. So we zoom out on larger time frames. We connect the most obvious levels. Like I illustrated, sometimes the price might at certain points break above or below your trend or the trend line. That's all right. We just connect in the most obvious levels so that we would be able to make an accurate prediction. We're not trying to say that all right, we have one touch at the top and they got some touches at the bottom, so I don't want to carry down at the bottom, we're just going to stay at the top. No, you need to take it to the point where there is the most touches. So if there's just one touch that is higher than 3 other touches, you connect the 3 other touches and not disregarding the one, but the 3 other touches is stronger confirmation than the one. So you adjust to get the most touches. Like I was saying, you are not trying to get the market to come up to your levels. Even if the lines aren't straight, you need to make sure you're connecting the tops and not just trying to get the market to adjust to your conditions. You're actually trading by the market's conditions. Alright, and that's it for this video. I hope it was helpful, and I'll catch you in the other one.